We are live. Hi, Adam. Welcome to Venture with Grace.
Hey, Grace, thanks for having me.
I like the wave. Um, okay, to start the show, I would love for the audience to get to know you a little bit more. So, I think you were working at a startup before entering True. So, you kind of started chatting with the True team when they were very early on in their founding journey of True Ventures. But now you have been at True for over 15 years. What were some core lessons that you've learned early on in your career, kind of shape you into who you are today?
Yeah, so I guess to set context, I joined True in summer of 2010. This was my first job out of college. I was the summer prior to True an intern at a True Ventures portfolio company.
Oh yeah, I think that was the case. Yeah, I think
Yeah,
you had some startup experience before.
my partner Phil in 2008 said, "Hey, we should figure out a way to get more college grads into the Valley to get them access to jobs." And so in 2009, they ran the first of our True Ventures Fellowship program, where we take 15 students each year, put them inside portfolio companies, and then once a week they come in and we spend time with them also teaching them about venture. I grew up in Florida. I went to University of Florida. The University of Florida is not a hotbed for venture capital recruiting, as you might imagine. Um, you know, uh, and so when I was graduating, I said, done a bunch of interesting things in the past. I had worked for a startup in healthcare. I had worked at a venture fund in Gainesville. I had worked for a currency trading fund. I had started this small business in music. And for me, I was really interested in technology and I was really interested in business. And I was like, I think that all happens in San Francisco. And so I was like, I'm going to go be an investment banker in San Francisco because I assumed I needed to get out of Florida. And I thought that was a job people did after college. I didn't know anyone in investment banking, and banks don't recruit from University of Florida. And so I called a bunch of the individuals I had worked with before, and I said, "Hey, do you know any investment bankers?" And one of the people I called was Phil Black of True Ventures, and he said, "Well, why do you want to do that?" And I said, "Well, I need a job." And he said, "Well, why don't you come to work here?" And I said, "To do what?" And he's like, "I'm not entirely sure, but we like you, and you should come here." The part of the story I don't normally tell is I actually said no to Phil twice. Because at the time, True Ventures was a startup in San Francisco focused on the internet. And I really wanted at that point to kind of like have a job with a brand that, people would take me seriously. Fortunately, no one else offered me a job. So tail between my legs, I called Phil back and said, "Hey, Phil, would you hire me?" And he said, "Yeah, absolutely." And so I joined True March of 2010, moved to San Francisco June of 2010. Our office was at Pier 38 in San Francisco, which has been since condemned for safety. I moved across the street to an apartment, so I had Townsend and Embarcadero, and went to work for this new venture capital firm. So this is now 16 years ago, and the True Ventures that exist today is very different from the True Ventures I joined. When I joined, I was either number 7 or 8 on the team. It was mostly the founding partners. We had a CFO, and we had an individual that today we would refer to as head of founder platform, but that's not how we were talking about it then. The firm had just raised its second fund. Again, 2009, 2010, San Francisco is dead. The internet is dead. Seed investing is not a cool thing to do. And I joined this startup venture capital firm in San Francisco, rats in the office, and I'm just excited to be there. And it's awesome. I'll pause there for 1 second. I'm happy to get into the lived experience of joining a startup, both as a market grows and a startups grows, but I want to make sure all that made sense so far.
I have so many questions there. So one thing is since True started right before you join, and then you have been there basically the whole time to help scaling this VC firm. What are some trends that you're seeing that's very interesting? I don't mean investing trends, but the venture capital trends. Nowadays, I feel everybody's the stage that you're investing in is becoming one of the most popular stage. And then back then there was four firm that kind of does this thing. And how do you think about, I guess, building up a firm? And also I was having coffee with a lot of people who are in venture back then, and then a lot of people have later on runs investors. So like maybe like someone is doing seed, someone doing A, B, C, or whatever, and then they would like share a deal collectively and then pass along the same deal to the same crew. And like, do you have like kind of like a investment pots back then, or how does it work?
Yeah, so I think I'll start. The best thing I did was say yes when Phil offered me a job. It was not strategic. I want to be clear. No one else offered me another job.
Mhm.
Um, and I would say this is probably broad advice that's in general. If you can join a startup that is about to grow really quickly in a market that's going to grow even more quickly, you should take any job because good things will happen over time. And so, I accepted the offer in 2009. I joined in 2010. To set the context, in 2007, True Ventures was 70% of the seed stage venture capital market. My partners, John and Phil, when they started the firm, they weren't the only ones with the insight. YC started around then, first round capital started around then, but there were not a lot of firms focused on kind of seed stage investing in internet companies. And so, despite that backdrop, by the time I joined, kind of things were hitting full swing. AWS had launched, and so there were infrastructure services. Mobile phones had launched, and the iPhone App Store specifically had launched recently. Social was starting to scale. And so in San Francisco, there was this energy and enthusiasm for something that was happening, but it was not clear, I think, outside of San Francisco. Just to be clear, the building that True Ventures was in at the time, Uber started there, Twilio started there, Automatic started there. It was an incredible place, and just to be surrounded with all that energy was great. The cool part about joining a startup venture capital fund is that it is a startup. And so I was thrown in and given the opportunity to do a lot of things that I was vastly unqualified for, but got to learn the entire venture business from the inside because we had a lot to do and not that many people. I was helping build financial models. I was helping building fundraising decks. I was helping companies do marketing projects. When my partners, John and Phil, started the firm, I can kind of talk about how they viewed kind of customers and product in our business in a little bit. But I think one of the things they didn't predict going in was the power of kind of community and connecting founders to each other. And so when I had joined, they had already started to see some of these early seeds of, hey, being a founder is hard. Building a company in a capital efficient way is new and different. The founders we work with wanted to talk to each other. In traditional venture at the time, that was crazy. You wouldn't let founders, CEOs talk to each other. That was not a thing that happened. It was siloed information for the partner. And so we had started to throw these events called Founder Camp, where we brought together all our founders in a single place and just let them talk. And that turned out to be an incredibly powerful thing for the companies. They had access to information that no one else had. It helped each of them get better faster. They were all answering questions that no one else had ever asked before. And it turned into this really valuable thing for us as a business in that today, 70% of our new investments are sourced from existing founders we work with, and 100% of the investments we work on are done diligence through the founders we work with. And so again, being there at the startup venture firm with only one person working on founder platform, I was there helping to work on events and got to learn the inside of the venture business as we scaled. I was there when we raised Fund 3 and then all the subsequent funds. And over time, I think it's kind of a natural thing that happens. I started spending more and more time on the deal side. When I joined, it was really just kind of the 5 partners who were around the firm at the beginning. John Callahan, Phil Black, Tony Conrad, Tony Schneider, Malik. And at some level, they didn't know what to do with me because they had never had a junior investment team member. But that was just great because they were like, we'll bring you to everything. And so getting to learn the venture business, it is one that is only learned, I think, through doing. And I think, at best, I get to be the mix of my partners who I got to learn from incredibly closely during that period of time. And so at some level, I think when people talk about venture, a lot of people focus about talking about picking investments, working with companies. There's an unspoken part that I actually think is really interesting that I was really fortunate to be a part of, which is kind of the firm building very much at the beginning.
Let's talk about the firm building and then the deal flow funnel. So you mentioned about 70% of existing portfolio are from the existing founder network, right? How do you program these things? And I think as someone so I've hosted over 15 dinner and 2 conferences primarily this year. And I feel one of the challenge would be how do you track these results? So some of them like some of the people like went to our dinner, but like sometimes, when I just met them once, and I feel like it's really hard to be like, hey, what are you like, continuously to track. Obviously, like, I mean, I have like put in like tiny angel investment into like some of these people who went to our dinner and then they went out to do amazing things. But I just wonder like how do you kind of track these progress? And then when you do these like founder camp, like what does the programming look like? How do you make sure that founders feel comfortable to talk to each other, but it's not like super loosely planned that like people have absolutely no agenda and they just view it as like, a social networking like event or something.
Yeah. Well, so I think you actually have to start at the beginning of True to get the best part of the story. And so 2005, so now 20 years ago, my partners John and Phil came together and said, we think there's an opportunity to build a new type of venture fund. Again, the internet was dead, seed investing was dead. My partner Phil had started a group called Blacksmith, which now was a $3.5 million fund, which we now jokingly refer to as the first super angel fund. But there were not a lot of funds like that, and there were just a handful of angel investors. My partner John was at a big platform fund, kind of more traditional Series A, Sand Hill Road, that wasn't interested in doing anything in the internet and definitely wasn't interested in doing seed stage investments. And on the side, they both were kind of investing in these new companies that looked really different. It was founders like Otis of Goodreads or Matt Mullenweg of WordPress, where they were technical, they were builders, they were closer to the product, and so they didn't look like a traditional like MBA with lots of business experience, but they were building things that were really interesting, like an open source blogging platform or a social network for readers. And because they were builders and because a bunch of new technologies had come out, it allowed them for the first time ever to kind of get a lot more done with less. And so they needed $300K, $1 million. They didn't need $10 million. And in fact, $10 million would have been too much and would have restricted creativity. And so, John and Phil kind of sitting together, they said, oh, like, could we build a new firm really focused on this creative type of founder who is technical, a builder, who needs a little bit of money to get started. And as we think about the best product for them, we want to have big seed funds, because while these companies may start small, over time, they will probably need more capital. And so if we can bring big firm resources to support them, both dollars and people, we think there's a really differentiated product for a new type of founder that isn't being served today. And so at some level, similar to any of our customers, the founder, John and Phil said, let's build a new business with founder as the customer. As an aside, just like any business, you have to also think about your shareholders. And so what John and Phil said is they said, hey, if the founder is our customer, we need to build a product that has a sustainable business over time. And so as we talk to our shareholders, which is my partners and our limited partners, like we want to have a story that's really around consistent returns in good vintages and bad vintages. We should have funds that consistently return 2 to 3x net of fees in a bad vintage, 4 to 6x fees in good vintages. But we really want a business that's durable. Part of the reason that we care about it being durable is that if a founder is going to start a company, it's going to take at least 7 to 12 years. By the way, I've now been on the board of a company for 13 years, and the CEO keeps telling me that we have another 13 years to go. But like the good things compound. And so our firm needs to be able to stay around, and then we need to have a team that wants to stay around, because other than that, we can't be the best partners to the founders we work with. And so we said in the beginning, we're going to build funds that have somewhere between 35 to 40 initial investments, where we are writing checks of $500K to $3 million to own 20%. The 20% for us was really around making sure we had consistent fund level returns and good vintages and bad vintages, so we could continue to have our shareholders re-up, so we can continue to support the founders that we work with over the long period of time. And what's cool, 20 years in now, we have lots of data to support that the business model works. We have over 1,000 founders we've backed in the community, 500 that are active. And at some level, it's like really exciting to think about the next 20 years building on all of the work we've done to date, and looking into the future.
For sure. I wonder, why don't we talk about like from the picking and sourcing? So like, I guess like one of the things I really like what you said about like, being enduring and then like making sure that like you build a sustainable product, whether your customer is the founders as well as like, there is side that you need to answer, which is like the LP side of things. Maybe we could start with like walking through one of your favorite portfolio companies. Like, obviously you have invested some really great ones like HashiCorp or Ring. Maybe we could start with like, how do you find these companies and to, diligence it, to evaluate it, and then get like winning the deal to eventually think about exiting.
Yeah. I'm going to take one step back and give it a little frame too, because I think at some level, like the history is important on some of this too. And so if you all go back to fund one and fund two, fund one really, what could you fund with $1 million in 2006? It was very much consumer web and media oriented. And so for us, the best source of new investments has always been founders that we've worked with previously saying that, hey, my friend, someone that I know and trust is starting this company. It's a little bit wacky, but you should take a meeting. It is great because it is the highest signal. Someone saying that this person matters to me from someone we already work with. It is also, it gives us a leg up into a way to win in a way that someone who's worked with us and is referring to us in the same way that, our portfolio companies would say, hey, we love founder referrals as business. We think that actually is very important here. And we can talk later about repeat customers. And so as we think about our world of investments, we have this diagram, which is 3 concentric circles where we care about 3 ingredients. And if an opportunity has all 3 ingredients, it is a core true investment. Those 3 things are founder, 1 to 3 technical founders who are closer to the metal. There's 1 founder CEO who is a protagonist who you could see in this future of building a big independent company, but they have a secret that means that they are better able to price their own risk. And they're making a rational decision to start a company. Because starting a company is somewhat of a rational act. The second is the market opportunity is unknown and unknowable. Because of technology, there's a new product that's never been before possible. If they can build that product, because it's not because that product doesn't exist, the market size for it today is $0. And so we aligned with the founders really like to take this market size, market timing, and product execution risk. But on the other side, if the founder's vision is right, we can see a future where this company does $1 billion of revenue and has a terminal value of $1 to $3 billion or more. And then lastly is deal. And for us, that is, we want to invest at the earliest stages of company creation. When the firm started in 2005, that was called seed. Today it's called pre-seed, and then sometimes called inception or formation. But I would say we are investing in rounds that we are leading where we can write checks of $500K to $4 million, and we are buying 20% ownership or more on that first check. We're going to do that 35 to 40 times per fund. And over time, what the data now shows is that we will be right 6 to 8 of the times at a material level. And really what drives the fund level returns is how right we are on the 1 or 2 when we are really right. On the Fitbits, on the Duo Securities, on the HashiCorps, on the Solo IOs. At some level, what drives fund level performance is how right we are. And so when we think about picking, we care about that as our framework, and that's how we view the world.
Can I ask a question on this? So one thing I've learned is, I think one of the things is like, I know that your firm is very different because of like, both of the partners who started the firm are like, in the industry for a long time. So you already have some sort of like customer / like founders in the network. Like if you're like absolutely have no background, and then like how do you even back the repeat founder or founder friends? Because I think if you have like, if someone's like starting a venture today or just like doing some angel investing, and then, how do you start with like the first batch of people? And I've controversial opinion. Like, so I have like personally invested in like tiny check into my friend's company who are, have all the right logos, like literally like, some of the hottest like AI company early Eng or whatever. And then like, study at like the most like prestigious like school, or like have the most like well-rounded, like quote unquote, like, I guess like the experience on paper. But like, yeah, like, I mean, I have backed like companies that are like, this guy I randomly met at this thing, and then like, went to our dinner twice, and I was like, okay, it looks like a vibe. And like, I feel like sometimes the second one performed better than the one that is like for a long time, because you're kind of like biased. But I guess like, how do you think about like, picking too? Because I feel like at the very early stage, there's absolutely no signal. You can just it's kind of like a random event. So how you kind of like got conviction at the very beginning, and obviously everybody loves like a good second time founder, like, or they have some sort of like they have sold a company before, even like maybe they're sold to very low valuation or something. But how do you kind of like deal with first of all, like if there's absolutely no existing pipeline, how do you build one? Second of all, it's like how do you pick after you build one?
Yeah. So I guess I'll start with, I can only answer from like the institutional firm side, because that's the business I know versus individual angels. I think a thing that I would say is, I've probably stolen from one of our investors, is like, I think to start, you have to answer the question, why does the world need another venture capital firm? And I would say, to flip it another way, you would say, who is the customer you're going to go solve for, and what's the product they need that's not met by the market today? Starting a venture firm is just like starting any other business. You need to have a customer. That customer needs to be unserved, and then you need to have an answer about why you're the best one to go and serve it. And so, at some level, that's part one. Part two is, I actually think, again, if you look at our data, picking is really hard. We used to do this exercise at the end of the initial investment period for each fund, so 3 years in, where at the time, the 8 of us around the table would go and say, all right, here's who we think the best 3 companies are. And with the 2 times we did it, not only did no one pick the right companies, we in fact all picked companies that were the worst performing companies. And so I would say these are companies we've worked with for 3 years. We're very close to, we're the largest shareholders in them. But even then, 3 years in, we were uncertain like which companies would be successful. And it was impossible to predict. We were like anti-predictors of it. So we stopped doing it. Right? We got jinxes the companies. And
You
so,
just pick one that you hate the most, and then
well, that's why we stopped doing it, like you jinxing the companies. And so I think at some level, like at the institutional investment layer, it's really about building a basket of risk that over time can drive consistent returns, because that is the kind of product we offer to our shareholders, who are our investors, institutional limited partners. I would say part of the magic of what John and Phil, when they started True, I think put together is, I think another thing they said at the beginning is they said, we want to build the best place to practice the craft of venture capital. Really, we want to build the place we want to work at for the rest of our lives. And I don't know if every firm thinks about themselves as building a business, but John and Phil in the beginning said, we're going to build this as a business and really a place we want to work at. One thing I'd highlight for us that's really differentiated and important in this conversation is how we make decisions. So there are 7 investment partners at the firm. Each of us is very different. I would say we are low ego, but I would say in the industry like venture capital, you're still sort of high ego, because I think it's hard to do this job if you have incredibly low ego. But I do think I love my partners, and we are high on kind of low ego humility. But what I would say is each of them is amazing. And I think any one of my partners could go out and raise their own fund and work by themselves. But I think we get really excited about working together as a team in a way that's really unique. One of the ways I think that keeps us all together is that the way we make decisions is non-consensus. So any one investment partner can get excited about a founder that he or she meets, and in some level get excited about the founder, excited about the founder's vision. There is work to do. Like each of us as a team will ask questions, we will help. We will 100% of our investment opportunities are diligenced by the founders we work with, who bring incredible insight and differentiated information advantage. But ultimately, if one of us is really excited, we're going to support, the partnership will support making that investment. On the other side, though, once the company is in, there's no attribution. All of our economics is roughly equal. There's no your deal, my deal. Every founder is fully supported by all of us. And we don't think about like the outcomes in a way that it will affect my performance. Again, culturally, why this is important is that on any individual investment, we need to be maximizing the risk. We need to be aligned with the founders that we're working with to take as much risk as possible. Product, execution, market size, and market timing. Because you need to believe that 1 or 2 companies is going to have the ability to be big and independent. And on the input, we believe every one of them does. And the dissension amongst us, every investment that has been great, in fact, is highly controversial internally. Not everyone loves it. And the ones that are more controversial are, in fact, ones that are both better and worse in the best way. You want that at the beginning. Like as a seed stage fund, you want that volatility. Because what ends up happening is that's what drives the fund level returns that matter to our institutional investors, is that we're going to pick 35 to 40 companies to start. When we make the investment, we think they're all going to be worth $10 billion. I promise you, like we are that excited about them on the beginning. Within the first 18 months, 24 months, Not all founding teams ship and hire. Not all founding teams move quickly. Not all founding teams show great judgment. You just don't know on the input. Even the best founding teams or even the best individuals may not work together as a team or things go wrong. And then on the market, again, the market we're investing in doesn't exist yet today. And so ultimately, is the market big enough? Can you get to the customers? Are they as excited as you think? Is there enough space to build an independent company? Those are questions that can get answered only really with data in the first 2 years. And so if I look at our data now, I would say I think we're great and great at many things. And I don't actually know if we can get better at picking. I think at some level, if I look at the transition from fund 1 to fund 2 and then onwards, we used to not care about market. We used to just be like, great founders, our type of deal, we should do it. And we learned that good founders in a bad market are not going to have a good time. So then we added that third circle, which says market, going into fund 2, but really fund 3. And then really what we've been better about each subsequent fund is understanding like, what does a big durable company look like? What are the ingredients at the beginning where you could see it maybe be a breakout? Part of that is like the type of founder who can move fast and run. But part of that is also many of the things that can make a big independent company. The other part is our business, we're not top-down market pickers. And so while the firm started in consumer web and media, in 2008, we had this founder come in who was introduced to us by another founder who said, hey, we're going to go build this hardware product called Fitbit, and we're going to help people be healthier. And in 2008, it was crazy that a VC fund should fund a consumer hardware company with $2 million. That wasn't a thing to do. But these were twice successful founders who have a huge vision of what they were going to do, referred to us by a founder we worked with, and we could write a check $2 million for 24%. We should do that every day. That investment turned into a bunch of other investments because once you enter a new market early, other founders show up because you're an investor who does that, and it becomes a compounding advantage in terms of information. The founders we work with, because they're experienced, know a lot more, and they're willing to share that information with each other and with us, which ultimately helps us make a better investment decision. The other example I'd use is in 2009, my partner Paneet invested in this company called Puppet Labs, which was an open source infrastructure company. $2 million. Every VC thought we were out of our minds. You can't fund a real infrastructure company on $2 million. Its competitor was called Blade Logic. It raised like $100 million. Like, what was Little True Ventures doing with a $2 million check? Over time, we've now done a ton of investing in open source and infrastructure at seed. I would argue we're one of the best. I think my partner Paneet is the best. And at some level, we now have this amazing community of founders who are sourcing for us, who are helping each other be better. And there's incredible power from that that compounds over time. I say all to say, picking for us is really interesting in that we are structurally set up to be comfortable being in new weird markets early before it's clear there's a market. And then once we're in those markets, we're set up to compound our advantage in terms of network and information, which makes better decisions. And so depending on where we are in the market cycle, how we make decisions is slightly different, but it's all built around this base of 1,000 founders that we have curated through our investments over the past 20 years. Like, that is our cornered resource, and it drives everything about what we do.
I have a question. So one thing is you mentioned, so for example, you guys invest in in terms of I feel like the market, how do you even pick the right market? Because I think it also really depends on the timing, and then I feel like it's very hard to enter something early, like you mentioned about the hardware and stuff like that, but because it's kind of right now, think about blockchain. I know that you are very big on music NFT, but I feel like a crypto NFT influencer on LinkedIn back then. I was that guy. So Kevin was actually one of our first NFT guests too. So I guess but that kind of shift towards I guess in 2022, people start realizing there's AI and a lot of big crypto companies just went downhill from there. But I guess the cycle, how do you kind of beat the cycle? And then I know that everyone is saying that you're supposed to invest before the cycle, but I guess you can't really dump the thing at the cycle because the cycle is 2 year long. For AI, everyone's talking about, is there an AI bubble? I don't think it's a bubble, but I guess it just everything goes up and down sometimes. So how do you perfect the timing piece as well?
I guess I would start with I don't think you can answer it, but but there is a lot of risk And rather than say, how do I control the risk? We flip it and say, how do we build a business that embraces the risk and in fact, doesn't view it as a bug, but as a feature, and then leans into it. And so, so there's a couple answers here which I start with. The first is everything we do starts with the founder in a way that starting a company is an irrational act. Grace, you are a founder. You could get paid more money to not do this. You would work less hard. It would be like a way chiller life, but you see something that others don't based on your lived experiences. And you're like, I'm going to go and do this thing. At some level, my job is to go and find people like that who see something that only they see, and they see a future that only they can build. And they are so excited about that. And they are very rational about their decision to start the company. Any of the founders we work with, the cost of starting a company is incredibly high. The value of their time is so high. To invest 2 years is crazy, just in terms of like the amount of money and stress and like, you know, resourcing. And so where I spend a lot of my time is finding people like that who understand the value of their time. And then when investing in an unknown and unknowable outcome, the best thing to do is actually just be aligned with that founder. And so when we're investing, the way we constrain risk is check size. So we write checks of 1 to 3 million. So think 1% of the fund. We are investing a small amount of money. A founder is investing his or her time. And we are then aligned to kind of go for it, where we own enough that if it works, it will drive the fund level returns that we need. But we go into it with the assumption that the market the founder sees is probably not going to form. Again, if I go back to our math, we will do 35 to 40 investments per fund. 1 or 2 will work, which means by definition, 35 to 38 are not going to work. And so we are wrong most of the time with the founders we work with.
I have a question on like the 1 to 2 that work. Like, so how many, like, what would be, I think I calculated for like, let's call it like a $10 million fund if you are investing in like 40 different companies or like a 250K tracks ish. And then in the end, like your ownership will like be from like C to like IPO, your ownership is basically like cut in half. And then if they IPO, like you have to have one company that valued over what, like I think it's like one, like there's you supposed to have like one company value over 10 billion and then 2 value over 4.5 billion, and then the rest can just, you know, 1x or die. But how do you think about like, you know, how much ownership that, like I guess like you guys take a very large ownership at the very, very beginning, so maybe that's like it doesn't matter, but like I guess like how do you think about the I guess like the portfolio construction math, and then like do you guys like follow on or not?
Yeah. And so to go back in history, so True Ventures Fund 1 was a $165 million fund. The fund return model assumed that in the world each year, there would be 2 companies started on the internet worth 500 million, and that True Ventures would pick one of the 2. That was the underlying portfolio math that drove Fund 1. 20 years later, it seems that the internet was bigger than 2 companies and the terminal values were bigger than 500 million. And I think this, by the way, goes to your market questions, which is really interesting. If you think about what we were investing in Funds 1 and Fund 2, you know, social applications, media applications, infrastructure and enterprise software, they were bigger markets than 500 million. I think people assumed like 250 to 500 million was going to be the outcome. It turned out to be 5 billion to 50 billion. And so that's, if you think about tail risk to the upside is great. We would love to be surprised, for us in our business model, surprised that a company is way better than we could expect, but we underwrite to really conservative things. And so even today, as we think about our fund model to investors, we say, great, each fund, we want to have 1 to 2 companies worth 1 to 3 billion. If we do that, we will be successful. This, by the way, goes back to your market question. And so again, in the beginning, when the firm was investing in consumer media, we were then brought into infrastructure software. We were then brought into consumer hardware. You know, again, each of these markets got bigger and we're compounding on prior markets. You know, in 2011, we made our first investment in a company at the intersection of software and biology called Moleculo. It was a really interesting company in that it was not a traditional life science company because it wasn't going to build its own hardware, but it wasn't a traditional software company because it had a wet lab. Again, for us, you know, 2 founders that were very dynamic and technical, introduced to us by a founder we work with, where we could write a $750K check for 20%. That company was very quickly acquired by Illumina, but that founder turned around and made 3 introductions into different companies. Pendulum, which was at the time called Whole Biome, and Deep Genomics being most notable. The reason I would flag Deep Genomics for you here, because it's interesting, Deep Genomics is a company that is, in 2015, was a founder who came out of University of Toronto. His name is Brendan Frey. Brendan Frey learned from Jeff Hinton, the father of modern deep learning. And while his classmates were all focused on kind of cat pictures, Brendan said, I'm going to go and figure out human genetics with deep learning. He did that for years, from the 90s into the aughts. Like, he was doing it for a long time, building out this lab that was highly specialized at the intersection of deep learning and human genetics, when both were bad ideas. He then had a paper published in Nature Biotechnology, and when we met him, he said, now is the time to go build the next great drug company at the intersection of deep learning and genetic medicine. I would like to emphasize, he said that in 2015. In 2015, those were both objectively bad ideas by themselves. And he was like, I'm going to put them together. And at some level in the world, we were not the only investor to meet Brendan, but when we made the investment, a bunch of investors said, how did you diligence Brendan? No one else has worked in this field as long as him. Like, how did you know, like, what was real? And for us, it's actually a really interesting answer, in that the fact that no one else has worked in a field as long as him, and he's choosing to dedicate his career, like to leave his teaching job to go and start a company that's really hard, and we can write a $3 million check for 20%. That's the type of investment I look for all the time. The interesting thing here, though, on markets is we didn't have a top-down thesis on investing in native AI, which is deep learning. But our first investment was in 2015. And through that, we met a bunch of other founders. And so since then have done 80 investments. I don't think you can time markets. And I think that is okay, as long as your business model uses that as a feature, not a bug. Companies are going to take 7 to 12 years to build or more. And you can't control the underlying markets. All you can do is choose the people you want to work with and have a big open space enabled by technology. And if you then say, all the questions you just asked about, like, will the market work? How big will it be? If you view that as good volatility, good things can happen.
Speaking of leading the deal, or I guess do you consider, I guess maybe in the early stage, you don't have to win the deal that much, because there's not a lot of people have major conviction at the very beginning. But didn't Sequoia just launch a seed fund or something yesterday? What's your thought on that? So it's just the big brands are they all have 5 scout program, and there's the early stage stuff, and then there's obviously YC and stuff. So how do you think about these people in investing in in the early stage market? Also, nowadays there's 500 emerging manager on the planet every month or something. So a lot of operators, or just younger people, start becoming influencer / investor, running their small funds. And obviously I don't think everybody can lead, but how do you think about the ecosystem have shifted, and then is there any new opportunities similar to seed back in 2006?
Yeah, so I would start with in 2007, I think True Ventures was 70% of the seed market. So the seed market, there's more capital here. Mm-hmm. But I would also say the terminal value of the potential of companies being started today are so much bigger. If you think about the opportunities being started in native AI, on top of crypto rails, using biology, the companies being started right now are so much bigger than I think anyone could have imagined back when True Ventures started in 2005. And we were doing internet investing in 2010. It's just crazy, some of the companies we get to work with today and their potential for impact, and just the scale of some of these markets that we're going after. So I guess I would first say, I actually take the opposite side, which I think seed stage investing is still dramatically underfunded. I love the fact that there is more competition showing up. I think there should be another 10 YCs, another 10 speed runs. There should be a whole bunch of firms. At some level, I think the ingredients for a new company is you need a creative protagonist founder who sees an opportunity to build something that was never before possible, and really the heart and desire to go make it happen, because it's so hard. And then you need two ideas put together that probably no one has ever seen before. And what's cool about ideas is because they're all remixes of existing ideas, as you have more ideas, it grows in a combinatorial way. And so like we have an infinitely large growing number of new ideas, which is amazing. And at some level, the technologies today that are mature, which I highlighted before, deep learning, blockchain, bio, like are going to end up with some monster companies. And so I think there should be so many more seed funds that should exist in the world today. The other part of this, by the way, that I think is unsaid is back in 2010, like it was scary to be a founder. It was like unpopular and uncool, but also like there was not a lot of information out there. Like the idea of customer development didn't really exist quite yet. Talking to customers, how to be a founder, all that information, it didn't exist. And so today, what's also interesting is if you have an idea, the idea that you can be a founder is much more like available in the world, and the information to go and do it is there. And so I think both of these things are in fact expanding in ways that aren't possible. And so I guess I would just say, not to not answer your question, I'm like, I think it's all underfunded, and it's really about understanding your investment model as an individual or a firm, really. Like, what is your customer? Who is your ICP? How does that, like, why is your product best for them? And then as you think about building a durable business, like how do you ensure you'll have consistent returns over time in good vintages and bad vintages across different market cycles? Like, we'll talk about crypto for a second, just I think it's interesting. We were introduced to Bitcoin in November 2012. Automatic, which is WordPress.com, was one of the first big publishers to accept Bitcoin. Three of my partners were on the board of directors at the time, and they came back to lunch and they said, does anyone know what Bitcoin is? And my partner, Phil, handed me $300 and he said, go buy some Bitcoin. And this is back when you had to go to like the red MoneyGram phone at CVS to call Mt. Gox, and Bitcoin was like $75. And it was weird and messy and maybe used for criminals because like all you could use at that point was like Silk Road. But like it was one of those things where you're like, oh my goodness, like once you see it, it's so cool. But again, from our business, the way we are designed is like we are looking for signal amongst the employees and founders of the companies we work with because we're staying really close to them. And so in 2012, we're buying Bitcoin, learning about crypto, meeting founders in the space. We make our first investment in 2014. Since then we've made probably 50 investments across that 12-year period. And at some level, we didn't need to know it was going to work. And I can't ever tell you anything's going to work. What I can tell you is that if I find great people doing really interesting things early, that's good. And if I find people later in the cycle using those technologies that are mature to build businesses, that also can be good. There's a moment in time, by the way, in all aspects of when we invest that actually we will not be in the market. So one constraint of our business model is we really think the best check for founders at the beginning is $500K to $4 million. And so there was a period in consumer hardware where we thought, where founders didn't want to raise our type of deal. They had access to more money at higher prices. There was moments in crypto where we kind of opted out of the market because we said that the prices were too high. We right now are not going to win every AI deal. There is some founder who is going to go out and be like, I want to raise a $300 million seed round for my AI scientist. I will start with competition is good. For founders, more investment dollars means there's more options of products. We could talk about why I don't think $300 million seed rounds are the best for creativity, but at some level, I love that someone's willing to go do that and hopefully build something really cool with that over time. Like create a founder with resources is what ultimately impacts the world in wild ways. It might be interesting to talk about the Ring story here in that context, but I'll pause in case you want to take it a different direction.
Why don't we talk about the Ring series?
It's fun. He also, the founder of Ring, has a book coming out in a few weeks, and I think everyone should read it. It's going to be awesome. But and I got to live the story back then, and it's dramatic. But Ring is actually a great example of a lot of ingredients of our story, where the founder of Ring, Jamie Siminoff, was introduced to us by two founders we worked with, Matt Mullenweg, who's the CEO of Automatic, and then Matt Brzezina, who we do not work with, but was a close friend of the firm. At the time, he had a product called Doorbot, which had been turned down by Shark Tank and did not work 50% of the time. It was a robot for your door. He had sold $2 million of the product and learned a lot of really interesting things around how customers were using it, how customers felt safe. And through that, he had a vision about how he was going to build the largest alarm company in America and lower crime in neighborhoods. Mm-hmm. But to be clear, it was called Doorbot. Shark Tank turned it down and the product didn't work. Structurally, though, for us, we invested $3 million for 20%. We, by the way, as an aside, everyone else had turned Jamie down. The company was insolvent by the time we funded it. But he believed, and he wasn't going to quit, and he saw the future. And when he talked to us, what we saw was that future: a company with network effects, a company with large subscription revenue, a company that did important things and like changed people's lives. Even today, like I'll watch the news sometime and they'll be like, a kidnapping victim saved with Ring. I'm like, that's incredible that like one person being like, this should exist in the world can make that kind of impact. What another cool feature of the story is, when we met Jamie, one of the stated reasons that other investors passed is they were like, the physics doesn't work. You can't build a battery powered product that uses Wi-Fi for video. And he was like, no, it works. We're using this new Wi-Fi chip that makes it possible. And at the time, it just happened that there was one other company using this Wi-Fi chip in the world, and that company was Fitbit. And so as part of our diligence process, Jamie and his hardware engineering team flew up to San Francisco and spent half a day with the Fitbit scale team. James from Fitbit was willing to do that because we were the first investors to believe in him, and we're really close to him and the company and supported along the way. He benefited from the community in other ways, and so he was very happy to give back and do something for us. For us as an investment, he said, yeah, this should work. And so for us, we had information that no one else has. That's proprietary edge. And I could rattle off examples of that forever. The other part, though, is Jamie called us afterwards and he's like, I don't have a lot of options in funding, but if I had a lot of options, I would choose you because no other VC has been this helpful. This is the singular most important thing that could have ever happened. This sort of information, I don't have access to anywhere else. And by the way, James from Fitbit said, you guys are awesome and I should work with you. And so I know I don't have a lot of options, so I'm excited to work with you, but I just want you to know, if I had a bunch of options, like I would choose you because this is like a differentiated experience. And what people who have worked with you are saying, like they rave about you. And at some level, I think of it as interesting because it kind of encapsulates the story of why our business model works, how we are structurally set up to make different decisions, and how, again, if you think about a world it's like in a world of abundance versus scarcity, I think there are so many Jamies in the world that have a great idea that could be as big and impactful as Ring, but at the partnership, they're scared to bring in the weird thing, the doorbell, like it was really weird, or the small fund needs the logo, so it only needs to be in the cool thing. They can't explain to their LP that like they invested in a doorbell company that Shark Tank turned down. Like there were so many reasons that would have been easy to say no, but structurally the culture we have, the founder community, both in information and winning, and our business model, which is really focused on embracing the risk, the unknown and uncertain parts of risk, aligned with the best creative founders. We're very fortunate that we will work with incredible founders who are going to build important things and like are going to change people's lives. It's awesome.
I love that. I wonder, is there like a program that you built to like do this at scale? Like, I don't think you need like scale, but obviously a lot of these are like very like craftsmanship. So like, there's like one specific company that can be like, matched with this one specific company. But I guess like, is there any kind of like system that you design to do these things, not as like a, ad hoc project, but like, for your 40 portfolio in 3 years that like this can like cohesively happen instead of I can only do this time but like next month. And because I feel like it takes a long time to like diligence something sometime, and maybe we could talk about like how long does it take for you to like diligence something, and then what kind of comfort level you have to have from product to like the finance side of things to like everything else that you have to get comfortable with something. And then is there like a system towards like building up a funnel to these like expert advisors from the existing founder network to kind of like let them vet the deals?
Yeah, so I would start with my partner Jeff and colleagues Madeline, Priscilla, and Julie are kind of the core of our platform team. They work really hard and they are the secret stars of what we do. I would say they did a lot of work prior to AI. They're doing so much more work now with AI in terms of internal tools, how you use the data, how software can help magnify a lot of this. The relationship, I think at some level is a very human business, but can we help, create visibility, create more efficiency. I think they've done a great job in that. But like at some level, it's a very human business. I think the first question you asked, by the way, was on, can you scale it? And I don't, I guess Roloff was on a podcast yesterday from Sequoia, and I think he talked about venture not being an asset class. And I would say venture is not an asset class. I think there are many different businesses that in fact have versions of that participate in the venture capital ecosystem, but they're all different. One of our investors, Stepstone, has an annual meeting. As part of that annual meeting, they ask each of their managers to go on stage and talk for a minute. There were 90 of us, and I was like, we're all going to say the same thing, but 90 of us said slightly different. And I would say how we approach the craft of venture capital is different from how NFX approaches the craft of venture capital, is different from how Proof Group approaches the craft of venture capital, and I love it. In fact, you can have going back to abundance. I think there are many fundable opportunities, and I think there's incredible amounts of space for innovation in how founders get funded to do really risky things that are unknown and unknowable. But I also don't know, at least for us and the way we practice the craft, if scalable is the goal. At some level today, I have 7 partners. They are awesome, and I love them. And I would brag about them forever. I think you've had Kevin on here and Puneet on here and Tony. And at some level, we're so different. And I love that, John, Phil, and Puneet as the managing partners, I think do an amazing job of wrangling us all together. But working with a group of investors like this, I think is an incredible experience. But I also don't know. And again, if you go to the math, each of us is doing 0 to 2 investments a year. 0 to 5 investments a fund. We run new funds every 2.5 to 3 years. And I think that's great. And I think it lets us have the stories like the Jamie or like the John Foley or like the Mitchell, and I think that's okay to not need to scale it. I think we're having a really great time with each other. I think we have a very particular style of how we approach the craft of contrarian investing in contrarian capital. And I guess I would say in a more broad sense, if you go back to 2005, there was not a lot of capital in the world for seed. There is now an abundance of capital at seed. And I think that's great and don't think it's still enough. I do think, again, through the lens of founder as our customer, I think what is missing today a little bit potentially is I think there's not enough conviction in a way that I think being able to say yes, to advocate to my partners to invest in a doorbell company or a construction of nuclear reactors company or pick your thing, an AI assistant. There are so many weird things we do every day. To have that conviction to be the first institutional investor to say yes, I don't think there's enough of that, and I would love for there to be more. But I think we have a system that we are particularly great at and a culture that lets us do it. The other thing I think that may be lacking is relationships. In that, I've been on the board of a company called Splice for 13 years. It's been awesome. My partner John's been on the board of PayNearMe for 15 years. I think part of our product to founders is you as a founder CEO are going to start the company. It'll take 7 to 12 years to build something of lasting value. But the best case scenario is you start as the founder who is technical, you scale into being the operating CEO, and you're the CEO for the rest of the business. I aspire, what some of the NVIDIA investors have experienced, the first venture NVIDIA investor is still on the board of NVIDIA. And at some level, I am so excited to work with a founder that I meet today who is young and technical. And at some level, in 30 years from now, if we're still working together and he or she is still doing awesome things, I love that. And our firm is set up both to structurally be around for a long time. Again, we're 20 years now. I'm 38, so I got at least another 20 years, and I hope that True goes beyond me. And then at the partners at the team, we've all been around the firm for a long time. I've been here now 16 years. John and Phil have done it for 20 years. The newest 2 partners at our firm, Mike and Kevin, were both founders we backed in 2008 and 2012, respectively. And so everyone at the firm has been around a long time. And so on a relative basis, if the firm has just started or if your partner is only a year in, I don't know if they can make that same commitment to say, I'm going to be with you for 7 to 12 years or more. We want to be around forever. And every decision we make is around how do we have a culture and a business model that means we can actually have that commitment and think about the world in that way, because it's really hard to get going in companies. And the most ambitious founders want to build big, impactful things. And the best part really starts year 10 when it's really working. 8 to 10 is when it starts to work. And at some level, I want founders who want to keep going, and I want to be able to be with them, and I want our entire firm to be set up structurally to support them for the whole journey.
I love that. So I want to maybe address one of the audience question before we wrap. One of the audience, Brenda, is asking, is there a different investment model that is used between software and physical infrastructure investments, since asset can be used to secure some value, even if a company was unsuccessful? Sorry, I didn't really understand the question. So it's like, how do you evaluate uh like a physical company plus software differently?
I mean, I'll answer Randall's question. Randall, thanks for your question. We invest 65% at or near company creation. And so when we're investing, it's 1 to 3 founders and often nothing else, pre-product, pre-anything, just like people. And we're like, great, let's be in business together. And so that's really where we focus, which is equity dollars and equity risk. Over time, as companies grow and scale, there may be the opportunities to tap into other non-equity forms of financing, which can be used correctly. And so, I work with this company, Pendulum, which is in the gut microbiome space. Everyone check out their product. We early on had physical factory infrastructure. And so rather than use equity dollars to fund that, we would use equipment financing, which is more like debt. General Catalyst has a new product focused on user acquisition financing. And so as companies grow and mature, there are often other capital beyond venture capital, other types of capital beyond venture capital that companies can choose to use. But where we invest, when it's like 1 to 3 people and an idea and nothing else, it is very much equity risk. And so just equity dollars from us tends to be what happens at the beginning.
Love that. Okay, so I want to be mindful of time. Maybe we wrap with a 1 minute fire round. What's your favorite book?
Favorite book? So there's a book called Origins of Wealth that is from an individual who is a researcher at the Santa Fe Institute, which talks about I would say, technology and business in a way that's all around compounding.
Talk about compounding. So like you actually wrote the article about innovation compounds. What are some interesting observations that you want to highlight?
Well, I think, and a lot of those ideas are borrowed from the book, which I think is great. What I would say specifically is, if you think about AI growth, like why are AI companies able to grow so fast? They're building on the back of things that are already there. Everyone has an iPhone. And so at this point, everyone has distribution. Everyone has broadband. So you have the ability to grow much faster. And so what's been really interesting is you think about each technology market cycle, they have the ability to be probably 10 to 100 times as large and 10 to 100 times as fast because they're often going to build on the back of things that are already in the ground. The infrastructure for cloud, mobile, and data laid the groundwork for all of the current AI applications. Without all that existing stuff, it would have taken way longer and not been able to grow nearly as fast.
Okay, so who would you invite to a dinner party?
Who would I invite to a dinner party? Lots of people. I know I'm hosting a dinner next week with one of my colleagues, Natasha. As we curated the dinner list, what I'm a fan of is I love individuals who are scientists, tinkerers, or people doing things that are interesting to them, but maybe not interesting to anyone else. And so at some level, if you're one of those people doing something that's interesting to you and almost nobody else, please find me on Twitter at @ADogEllie and send me a DM because I am interested in people interested in things that may be only interesting to them.
So many interesting stuff. Okay, so who made the biggest impact in your career?
I've been really fortunate along the way that a number of people have taken a liking to me early on. When I was in college, I had this thing where I would read about interesting people and email them, and then they would respond. And then I'd be like, can I do work for you? And they would say yes. And it's remarkable. And so at University of Florida, I worked with a professor in finance named John Benko, who helped me kind of set up doing research. And I was a TA for him and helped him write a book. The individual who runs the entrepreneurship program, Jamie, I was like a weird black sheep at Florida because I wasn't a finance person and I wasn't an entrepreneurship person. And so they helped kind of create my own little world there. Phil Black and John Callahan at some level gave me a shot in a way that I was a college grad from University of Florida who had never had a job before. And they said, you should come join our startup venture fund. And it's been great. And I would say at some level, like every founder I've worked with, especially back in the beginning, every day I kind of get to go out and say, I get to learn about all the coolest things that anyone's working on, and people are excited to share it with me. And I'm just an enthusiast for learning about new things. And so probably everyone I've met along the way would be part of that.
Love that. I wanted to ask like a piggyback question very quickly. So like what do you feel like separate you from like all these other candidates from like University of Florida? Because I feel like it sounds like, at the beginning, as you mentioned, like, it was not like the most popular school to like get recruited into the venture/startup ecosystem. Like how do you find out about the opportunity? And how do you become like a fellow at True? And I guess like yeah, like first of all, like how do you find out about this like universe of like startup and venture ecosystem? And then the other part is like how did they kind of like pick you? Like what are some characteristics that you feel like you kind of stand out?
Well, so in 2009, so I had started this small business, which if you looked at it now, you would say was a donation-based record label where we operated a venue, we released records, I was in a band. And so
I listened to this about a podcast you did with Cooper Turley, which is actually a podcast guest on our original show, like Keeping Up with Crypto, because I was like a crypto influencer. So it was like a very niche of the niche thing, but now it's like huge. But anyway.
And so along the way through that, I was like, being in a band probably isn't for me, but this business stuff is cool. And the internet is like a thing that I now know about because we built a bunch of marketing tools. And so I started kind of doing consulting projects for different companies in Florida. I was teaching a class on the internet and business, not because I knew anything, but because I raised my hand and said, someone should teach a class on the internet and business. And they said, why not you? And so in the summer of 2009, before I graduated, I had one or two consulting clients. And so, but I was like, I want to go to San Francisco. Let me look for opportunities in San Francisco. And so I stumbled upon the True Ventures website and this WordPress form for the True Ventures Entrepreneur Core. And I filled out this WordPress form, and then I didn't hear from anyone ever again. But because I had no other jobs, I was just moving to San Francisco for the summer. And so the week before the program started, I heard from this individual Christian. He's like, hey, you're in. And I said, cool, I'm here. Let's do it. I think our first class was 12. I think like 14 people applied. And so I think the first answer to you is I applied and was not so bad, I guess. And it was awesome. And then at some level, I think I spent the year, I worked with a portfolio company called B Stock Solutions. And because they were in Menlo Park, I would spend a day a week in the San Francisco True Ventures office. And so just because I liked venture and was curious, I would bother the partners. And so they spent enough time with me that, when I called Phil and was like, hey, I need a job. Well, I didn't ask him for a job. I asked for another job. And I think he mainly just wanted to prevent me from becoming an investment banker because he's like, you shouldn't do that. We'll figure out something for you. That he offered me the job that I took. And so at some level, I don't think today, getting a venture capital job at True Ventures, I think is one that people will want and would be highly coveted. But moving to San Francisco in 2009 to join a startup venture capital firm focused on the internet was not like, it wasn't a lot of people being like, I'm going to go do that. And so I was fortunate that I made a non-consensus decision early in a market that seems to have grown. And so a lot of it is right timing and people taking a shot on me. And then venture is really just about like curiosity, hustle, and a little bit of luck. Like joining a venture firm in 2010 was a great time to start being a venture capital investor. And so there's a big piece of this that is luck, which is I was early on, the firm was small, there was a lot to do. I had a lot of energy and enthusiasm and just was like, I'm going to go meet people and work all the time. And at some level, because of that, I met a bunch of people who became great founders, and it was a great time to be building really cool things. And I would also say I didn't know anything, and I would argue not knowing anything made me a better generalist investor in our model, in that I could meet the founder of Ring, who's building a doorbell company, and I had no fear about bringing that to my partners because I was like, this is exactly what we do. I didn't think about the idea that it was silly, that or they had been turned down, like all the things a normal venture investor would be like, I don't want to get fired for doing that. I had no knowledge of why things were bad ideas. I was just like, he's a great person. They're starting a seed company. It seems cool. And so I knew enough to be dangerous, and then had really supportive partners who I think helped me grow into the investor that I am today, which has been awesome.
Amazing. I love that, Adam. Last question. Where can we find you outside of work?
Outside of work, I play. I like work at some level. Like it's, I have a girlfriend. She's great. I have a dog. We hang out together. I read a lot. If you go to my blog, there are more books than the one that I mentioned here. If you're into obscure economic theory and venture capital, that I highly encourage. I really enjoy this sport, paddle, because I live in Miami. And then I'm a big fan of live music still, both punk rock and dance music. And that's me. You can find me on Twitter at @ADogEllie. Thanks, Grace.
Well, thank you, Adam. Super appreciate you. And thank you so much for everyone who joined in the last 20 minutes, because we literally, this is like maybe our second most popular episode. And then like everybody joined like right before we about to wrap. Like it was like a very intense. I was like looking at the number. I was like, wow, okay, we did it. But anyway, thank you so much, Adam. Let me quickly end stream.